following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And it is Saturday. We're talking about money. And on this day in 1961, the Poppin' Fresh Pillsbury Doughboy was introduced. And my guess is Silicon Valley Bank could have used some dough this past week. Silicon Valley Bank, of course, collapsed. It collapsed, and that sent reverberations through the market and has made considerable change happening. But how did it happen? Why did it happen? And why do we think it's isolated? And why do we think that there were a lot of signs beforehand that both investors should have been aware, regulators should have been aware, and the management simply screwed up? You know, a lot of people have blamed regulators for not seeing it. I've heard on Fox News, they're calling it wokeism that did it. Wait a minute. Come on. Diversity didn't bring in the bank. The bank had no risk manager for 8 months. When the Fed began to raise interest rates, how could the president of the bank not been aware that some of their securities were going to be underwater? 90% of their depositors were uninsured. Compared to the normal bank, the big banks, it's around 40%. For Silicon Valley Bank, it was 90%. Highly concentrated in depositors who were uninsured, depositors who had more than $250,000. In some cases, like Roke, for example, they had $400 million in the bank on deposit. So what happened? It seems, going back and talking, when a bank gets a deposit, they don't just collect the cash and stick it in a vault. If somebody deposits $1,000, they have to set aside, and the reserve amount will change from time to time, but say it's 5%, they have to set aside 5%. $50 they have to set aside, and they loan out the other $950 out of the $1,000. And that $950 then gets redeposited in the bank, and they have to keep 5% of that. So they have to keep $40-some. So now they've got $900 more to loan out. They've got a loan already for $950, they've got another $900 they can loan out, and they loan that. And they have to keep 5% of that. So they have to keep $45. So now of that $1,000, they have now loaned out $2,700 plus. And they will continue. And if you continue that sequence all along, if everybody just puts their money back in the bank on that $1,000, you get up to $20,000 that are loaned out. Actually, $19,000 because $1,000 ends up as reserves. But you end up with $19,000 loaned out. And usually those loans are long-term loans. Think about your house. That's a 30-year or 15-year loan. The money isn't readily available. So that's how banks work. That's how banks make money. And they pay you 1%, and they're charging loans at 6 or 7%. So they're making a nice spread on the money that you deposit. That's how banks operate. That's how Silicon Valley banks. That's how Chase operates. That's how First Sound operates. Even small banks like First Sound, which is a very good bank, by the way. If you haven't considered it, you should consider it. But that's my plug anyway. That's how banks operate. So what went wrong with that whole picture?
They had said, you ever been to beach? Hey, who's watching the kids in the water?
Yeah.
If nobody's there to watch, that's when something happens.
So,
and that's what happened. Who was watching? There had risk managers. Who was in charge? Paying attention to funds when interest rates rise, long-term bond price relation. Who was watching the book of business? We need some adjustment.
Obviously, they weren't watching. And let's talk a little bit about that, because that's classic 2000.
It is.
And, when you have an uninsured deposit, if somebody deposits $40 million or $50 million, they want to see some assurance that there's some insurance on that money. And since the FDIC only guarantees up to $250,000, what the banks will do is they'll go out and they'll buy bonds. And usually those are repos, things that no one had ever heard of before 2007 or 2008. Mm-hmm. Now everybody knows what a repo is and what a credit default swap is. But they go out and they buy these repos. They're collateralized mortgage obligations. Banks generate these mortgages. They're packaged by Wall Street into bonds, and the banks will buy those because they're paying depositors 0.5% or 0.25%, and they're collecting 4 or 5 or 6% on those bonds. So they're making a nice spread on those. But those bonds trade in the open market. Originally, they were called 7-day sevens because they came in $7 million amounts, and they traded every 7 days at 7 a.m. 7-day sevens. So those were the bonds that were at that time, there were not that many. Now it's grown dramatically because of the number of high uninsured depositors. And those bonds drift in value. But what banks can do is they can say, we're just going to hold these to maturity. And so we don't have to mark them to market. Marking to market means you have to reprice that security every day for your book. If you say you're going to hold them to maturity, you're going to get all your money out, you assume. You're going to get $1 on the dollar for everything you spent, plus you're going to get the interest. So that's the concept of we were going to hold them to maturity. So even if those bonds drop in value or increase in value, they're still held on the books at the same value. But it doesn't come just easy, because if you do that, there's no reason to hedge. There's no reason to hedge, and you're not allowed to hedge. So if interest rates move up and the value of those bonds move down, you show them on your books as being at par when they could be 5 or 10 or 15% below par. And there's nothing you can do to hedge against that. That's what Silicon Valley did for most of the insurance they had on uninsured deposits.
Back to 2000. This is what banks did before 2008, why they got in such trouble. Then they made all these changes. It started in Europe with what's called Basel III, where they came down with bank regulations saying what's called liquidity coverage ratios, where they had to have so much liquidity. They set that base at about 250 billion was where it was banks that were considered significantly material, large enough. They set that ratio where they had to meet some liquidity coverage requirements. And people say they changed the regulation in 2018 to lower it, so SVB lobbied that, so SVB didn't have to be part of that liquidity coverage ratio. But upon doing a little bit more digging, that's not necessarily true, because all these banks, any bank, Mike, that has over $5 billion in assets, which isn't a huge number, has to file what is called, I will find it here in a second.
We're looking for the notes.
Sorry,
he's going to find it.
I'll find my note here. I just had it and I lost it again. I think it's called FRY-9 report that goes to the Federal Reserve. It's a 76-page document detailing every asset on the bank sheets. Balance sheet, income, everything. Off the book transactions, off the balance sheet transactions, everything. So to say that the bank didn't know, that the regulators didn't know, is not. They knew. They knew what was going on with the bank. If anybody had looked at that, they would have known.
They should have known. And they did know. And yet they didn't really take any action to do it. So why didn't they take action? There's a couple things. Gregory Becker, who was the CEO, had been in banking for 30 years. Not only had he been in banking for 30 years, but he lived through the 2008 time period. Mm-hmm. He was a banker during that time period. He got to see what happened when you have a bank run and a bank panic. You have to guarantee your depositors. We did not have the classic run in 2008 because there were credit default swaps, which guaranteed the amount of the repos. We're coming to a commercial break. Don't go away. This is a big question to understand. And the whole thing behind this is, how does it affect investors? Not investors in Silicon Valley Bank, but investors in other companies as well. We're going to come back and talk about that as well, because that's important to understand. Why did Silicon Valley Bank do what they did? We'll be right back after this commercial break. Don't go away. We've got so much more to cover.
About Money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
We're talking about Silicon Valley Bank, talking about what they had and some of the similarities to 2008. I formed Adams Financial Concepts in 2005, so I lived through 2008. I remember that very well, very, very well, too well in a lot of instances. But there was a difference between what happened in 2008 and what happened with Silicon Valley Bank. First of all, let me talk about 2000, because you had similarities, because you had depositors. Beginning in about 1975, you have depositors who had a lot of cash, far more than the, at that time, $100,000 guarantee by the FDIC. You had endowments. You had hedge funds. You had all sorts of companies, financing companies, GE Capital. You had General Motors Capital. You had those companies who had a significant amount of cash. And when they put it in the bank, they wanted to be insured. Way above, their amounts were way above the FDIC. And what they were doing is they were asking the banks to go out and buy securities that would guarantee their returns. And what was available was the collateralized debt obligations, something that came to be known after 2008 as those toxic securities. They weren't that toxic, but they were collateralized mortgage obligations that had put a lot of home mortgages, even subprime mortgages, wrapped them up into bonds with the assumption that only 5% were going to fail. And so if you put 105% or 106% or 110% into a collateralized obligation, that even if you had a few failures, it would be a few failures and you'd be just fine. No one figured that a carpenter in California and a dentist in Cincinnati and a shipbuilder in Louisiana, all their homes were going to collapse and be foreclosed. No one figured that. That was never in the odds. And so a lot of those bonds got AAA rated. But even at that, the depositors wanted further insurance and the banks wanted further insurance. So they went out and they got what were called credit default swaps. Credit default swaps, most of those were done by AIG, and they figured the chances of things going wrong with a credit or with a collateralized mortgage obligation or a collateralized debt obligation, the odds of something happening were so small.
Nobody believed the housing market's going to...
Yep. And so they did not even have a reserve for any losses. And so what happened, as homes began to be foreclosed and people began to realize the statistical methods used to...
One thing, Mike, we talked about is that we talked about it last time in one of the previous shows. Sorry to cut you off there. Is that we talked about why the economy's going up, why people are still spending. And the amount of people who were able to lock in fixed rates at low rate as opposed to variable rates was like 60 to 10. It went down from like 60 to 10, only 10% were variable. Back then, all those loans were resetting on their 5 and 7 year arms because they said, oh, just buy it on interest only.
Yeah, that added to it.
Yeah.
But statistically, the statistical methods used to analyze those CMOs was wrong. And that's a crucial question, which bugs my industry all the way. But anyway, that's another subject. We'll talk about it at another time. But the analysis was really wrong. And so when people began to be foreclosed out of their homes and those things began to fail, you had a run on the stocks of the banks. Even though the depositors were not withdrawing their money, you had people shorting those stocks and pulling their money out of those stocks. And the stocks were being shorted down because people believed those banks were going to fail. And so you had the stock prices going down. A very different situation than in Silicon Valley Bank, where the depositors suddenly decided to withdraw their funds and ran into the same problem that the banks had in 2008. Now, during the break, you brought it up, Al, what happened in 1998 when long-term capital failed.
It did, because one of the banks decided not to go in when the federal bank, let's bail them out. Bear Stearns, we're not going to be part of the bailout. What happened to them in 2008 on March 16th?
On March 16th.
Bear Stearns went belly up.
Yep.
Sort of payback, not helping out bail out long-term capital in 1998. I'm not a conspiracy theorist, Mike. There's something funny going on at this bank, because even like Bill Ackman of Pershing Capital runs $20 billion hedge. So look, this is a critically significant bank economy. They help fund technology and venture cap. They fill a pot that's really not being filled by the major banks. So why don't we just bail them out? And they didn't get bailed out. Or maybe they will. I don't know. They didn't get bought, bailed out, or anything.
Silicon Valley, you mean?
Silicon Valley Bank, yeah.
Yeah.
And so letting them go, I don't know what politics or what's behind the scene, but there's something's a little fishy about it.
I don't think there's anything fishy. I think it's a single bank. If you have the banking system, which is in a banking crisis, financial crisis, had they allowed all those banks to go belly up in 2008, it would have crashed the financial system.
Right.
The same as 1998 when long-term capital went in one day.
One day, because of the Russian ruble. They bet on the Russian ruble. I agree, but they're specific to allow Bear Stearns to then go belly up, right? It was political, right? They could have came in and said, let's save that. What doesn't make sense? Let's save this bank. And they didn't. And they could have done, and like Bill Ackman said, and I agree with them, they could have done the same thing here. Didn't. There's got to be something at play that we're not necessarily getting. I think we'll get it eventually, but there's something.
No, I think because Bear Stearns didn't step up and do their part in 98, the Fed and Treasury were not going to do anything to help them.
But
And remember, who was head of the Treasury at the time? Paulson.
Paulson, yeah.
Paulson came out of Goldman
Goldman
Sachs.
Sachs.
And they stepped up and did their part.
But what happened to Goldman? So they were an investment bank before 2008, and they converted. If they had so much invested with AIG, had they not been able to just all of a sudden they switched from an investment bank to a holding bank, they would have went belly up with
Bear Stearns. Yeah.
They were so heavily tied with AIG.
So what's funny is there is a parallel with Bear Stearns and Silicon Valley Bank. 2 months before Bear Stearns died, Jim Cramer came out and said Bear Stearns at $72 a share was a table-pounding buy.
And he said this one wasn't
Two months later, Bear Stearns was gone.
Yeah,
at $2 a share, $6 or whatever. Silicon Valley Bank a couple months ago, Jim Cramer said it's a buy. It's a buy. I think he meant BUY and not BYE. Or BY.
Yeah, exactly.
Not a goodbye.
Yeah.
Like, we'll see you later. Goodbye. So coming back to what happened, there's a difference between Silicon Valley Bank, and that's they actually had a run of depositors. And you would think that Becker would understand that.
But who was it? The venture capitalist Peter Thiel, who called his clients and said, this started on a tweet. It was I forget who sent the tweet.
It started with a tweet.
And then Thiel said and called all his clients and said, pull your money out of the bank.
But the one thing you have to do to make sure you don't have a run is you have to assure your depositors that you're good for the money. I had a professor at Carnegie Mellon when I was doing my MBA, Lee Bach, an economics professor, and his dad had owned a bank in Nebraska. Mm-hmm. And in the 1920s, they had the potential of a run. Rumors got around that the bank was in trouble, and probably was. I don't know. Bach didn't explain that part. But he said that when the rumor got started that the bank was going to fail, his dad drove hundreds of miles to all the other banks that are around and gathered up cash, because you don't have enough cash at a bank to pay off your depositors, whether it's Silicon Valley Bank or whether it was this little bank in Nebraska. So he got all this cash, and when they opened the doors, he's standing on a desk and welcoming the people in, saying, of course we've got your money. All you have to do is just step up, ask for your money, and we'll give you the cash. Mm-hmm. And the people, seeing that, took their money out and redeposited it. By the end of the day, everybody had redeposited their money. He spent that night returning the cash to the other banks, and he saved a run on the bank. Becker did nothing to prevent a run on the bank.
Why did he do it? That's why it doesn't make any sense to me. That's why I say there's something more nefarious going on. I don't know what was going on, but why couldn't he do anything to prevent a run? Why wouldn't there be someone to back him up? Why wouldn't the other bank come together and say, hey, let's do something?
I think he has to do it. And I think he has.
I know, but I just don't think so, because I was doing some more reading on this, the regulations, when they changed the regulation. And this guy from the Federal Reserve who talked about what happened in 2008.
Yeah.
And what when they put these liquidity ratios on banks, other thing, net stable funding ratio, bank liquidity, it changed how banks operate, and it made things more stringent, which everybody wanted. But it also had a reverberating effect on other businesses and non-bank financial holding companies and how things were run. I'll explain a little bit of why it contributed.
We're going to come back and talk about that. We're going to talk about Silicon Valley Bank and what investors really need to understand.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
So, Mike, before the break, we were talking about some of the things that might have contributed to SVB's downfall. And the change in regulation in 2008, when they adopted from Europe the Basel III and the new liquidity requirement ratios for these banks, what banks started to do was any bank that had over $100 billion in assets, what they had to do was they, instead of holding tons of the big banks had to hold liquidity because they had the money. Mm-hmm. But what it did is it forced smaller institutions like SVB and other companies, especially like insurance companies, to have to say, hey, instead of us having to hold all those reserves in cash, we're not going to do that. We'll leave it at the banks, and they'll just let them issue us lines of credit.
Yeah.
And that's kind of what happened. So the banks now, the big banks had to hold all this cash, but banks such as this didn't have to hold this amount of cash or liquidity. Yeah.
Well, in theory, if the Fed had not been raising interest rates, they had plenty of liquidity.
They did, yeah.
Although, even at that, when you look at where they were in terms of deposits, their deposits have been increasing dramatically until 2022. During 2021, they reached a peak, and the number of IPOs and mergers and acquisitions that...
Their deposits dropped by around 16%. $15 billion.
Yeah, the deposits began to drop. And companies, a lot of the companies that had put in a lot of money were losing money.
Right.
And they were drawing money out.
And to say that they didn't have, just to go back to the regulation for 1 second, to say that the regulations were so lax that they didn't have to fill out the form, like I talked about that, that NFR 9 forms they had to fill out. The big banks over $250 billion were stuck with these liquidity requirements. Any bank that had $50 billion to up to $200 billion had to do some sort of modified of that form and they did have to do something. It's not like they just didn't have to report. They did. They probably just didn't have to do it to the stringency if they had over $250 billion, but they still had a lot of reporting that they had to do.
That's for sure. And even though they were reporting it, the regulators weren't doing it.
No, and it would have been the state at that point, it would have been the state of California regulators who probably would have been more closer to the situation than the federal regulators.
And I want to talk a minute about one of the issues that's been raised about the stress test. Because coming out of Dodd-Frank, Tim Geithner was not a very popular person. They didn't think he's very capable. But one thing he insisted on were stress tests. And part of Dodd-Frank, the bill that was written, were banks had to do stress tests.
And that's what these were. These liquidity coverage ratios were stress tests.
Yeah.
And so when they reduced the regulation to say, banks under 250 didn't have to do it to the stringency of banks over 250, but they still had to do some sort of stress test. And it wouldn't have stopped the bank regulators in California from saying anyways, hey, that might be their threshold, but this is what we want you to do.
And that would have shown up. But, the main problems, there were regulator problems, no question. I think that Goldman Sachs had a hand in this whole thing. Because when the bank wanted to raise money, they went to Goldman Sachs for their advisor. And Goldman Sachs raised $500 million on a private placement, and then we're going to raise $1.75 million in a public stock offering and convertible bond offer. Goldman Sachs had to have seen the books and seen the issues were much deeper than a $2 billion shortfall.
Yeah.
They had to see that they had they had not marked to market their repos. They were carrying them at hold to maturity, and there was a big hole.
And that's why I say there's something more going on. Why Goldman Sachs, JP Morgan, all those banks didn't get together and say, let's do something. They didn't.
Because, the only people that were really affected by the end of the weekend were the shareholders. The shareholders are probably going to get nothing. The depositors, if you look at, even if they sell the repos at a loss, there's still assets that the bank holds.
Okay, let me ask this question. If this bank is still sort of not dead yet, but it's still floating a little bit, right? What bank is going to step in, fill the gap of doing the lending to venture capitalists and like that bank did?
So
who's going to fill that hole?
So it was not a lot of lending that was going on. It's depositors. So when you have a company that goes out and raises a Series B, C, or D round of funding, they get a whole lot of money. If you look at DocuSign or Twist or Okta or some of those companies that have not, Snowflake, those companies that have not yet reached profitability. There's a path to profitability, but they haven't reached profitability. They go out and they raise a ton of money and they deposit it in the bank. They're depositors. They're not loaning.
No, right.
So the question is, what do they do there? And I think there's a lot of banks that will be happy to pick up those deposits.
Oh, I agree. That's why I'm saying why they wouldn't bail them out, right?
And, a lot of venture capital contracts, when somebody did a Series C or D or F round or whatever it was, required those tech companies to deposit money at Silicon Valley Bank. I mean, talk about setting it up. But I don't think that any of the competing banks had any thought. Well, first of all, when the bank was getting close to collapse, they couldn't find a buyer because it was too short a time and everybody could see the vulnerability. Mm-hmm. And when you had the $42 billion run that happened on Friday, it was immediate. The bank was immediately put into receivership and the decision was made that the depositors would be paid in full and the shareholders be damned. Now, the shareholders have formed a credit committee already, but my guess is they'll get zero. But thinking about shareholders and Silicon Valley Bank, talking about that, there's such a focus with people looking at income statements. If a company misses earnings by a penny, the stock can drop 20%. Are you kidding me? If they're supposed to earn $2.34 and they earn $2.33, the stock drops 20%. It makes no sense whatsoever. But people become so focused on the income statement. And there have been surveys that have been done that show that CEOs and CFOs of companies know that meeting the earnings expectations of stock market analysts at companies and investors is crucial. And so they'll push to accelerate sales so that they meet it. I don't trust most companies' income statement.
No, I'd say Warren Buffett talks about that, right? Talks about the quarterly reports. He says, who cares about what happens quarter to quarter? Anything can happen in a quarter.
Yeah.
Right? In a football game, what happens in the first quarter? If it's 14-0, does that mean the game's going to end up 14-0?
And who would make a huge bet on a team that's down 14-0 after the first quarter?
I wouldn't.
I mean, but this is what investors are looking at. And this is Silicon Valley Bank was really good to shareholders, and they really focused on seeing that their earnings were growing. But most, except for one analyst, only one analyst asked a balance sheet question during earnings call. Everyone else was asking income statement questions. Only one analyst asked. And then after asking not about the repos and where they stood in terms of a market value, then he finished by saying, "Good quarter, guys." No, not a good quarter. A month later, the bank has collapsed.
Yeah, I don't know how these things work, but I'm assuming that they don't get invited back in if they ask too tough of questions or if they're too critical.
Yeah, but I mean, that's part of the game.
I know it is. I know.
But there's a lesson to be learned from that as well. I'm a balance sheet guy, and maybe I have a bias that way. Maybe that's why I view this whole thing with Silicon Valley Bank and some of the other companies. I want to look at the balance sheet and see that the company is really solid. I remember Enron. Enron quit publishing their balance sheet, period. They only put out for public use their income statement because the balance sheet was so full of irregularities. They didn't want anybody to see what was on the balance sheet. And when you have something like that, there's a problem. There's a way to analyze the balance sheet of a company and see if they're healthy or not healthy, and to look at the progression. Somebody once asked me to make a comparison of Starbucks and Krispy Kreme. And I can remember putting up the income statement of both companies, which the income statement looked almost the same. And then I asked them to put up the balance sheets and what's happened. And companies grow because they generate cash from earnings, from borrowing, or from selling capital stock. Starbucks was earning their money and they had essentially no debt. Krispy Kreme's debt was growing faster than its revenues were. And I said, there's a huge problem.
They were that's when they expanded too fast.
And they collapsed. Not completely, but enough.
Mm-hmm.
So for me, it's a balance sheet question. It's not just looking at the income statement, and I don't really care if companies are a penny or 10 pennies short on their income. I want to know that the balance sheet is getting better and better and better. We're coming to a commercial break. Don't go away. We want to finish this up and talk about some of the implications.
Mike, so we just finished talking about SVB. You talked about the income and the balance sheet, and you're a balance sheet guy, both looking at the balance. One other bank is in serious trouble to talk, and I think there is some serious nefarious activity at this bank.
Credit
Suisse. But Credit Suisse is a different animal. They are what's called a G-SIB bank, which is a globally significant bank. There's 30 of them in the world. I'm not going to go through all 30 of them. You can look and go guess which ones.
They're the biggest.
6 years. They're the big boy. But they've been a disaster for years. I mean, it's not like this is new. They had, can't pronounce right, Achego's Capital, where they made just poor investments. They lost $5.5 billion. I think it was Greensill, another firm that they lost $1.7 billion. They got ensnared in not anti-money laundering. They got ensnared with not being diligent enough on the anti-money laundering.
Oh, yeah. They allowed people to launder money through the bank.
Yeah. And so they had people there that they were laundering money for that were, one guy was in the Middle East and he was going to kill his superstar girlfriend. One other guy was in the Philippines. He was trafficking in people, drugs, and they hid all this stuff from the Swiss banking laws are so protected.
Well, remember, up until 2000, the Swiss bank accounts didn't have to give out any information. So they had drug traffickers, they had mercenaries, they had everybody going through there. And if a person was being prosecuted, and they couldn't get the banking information. The attack on the Twin Towers changed that. But the bankers who've been around a long time still had the mentality of not letting people know what was going on.
No, who was it? I can't remember, but it was through like Colombia or somewhere in South America where someone broke how the money was being funneled and found some of the wealthiest people in the world who were funneling money to these banks without nobody knowing, and not just for tax havens, but for really not doing good things.
And Credit Suisse, Deutsche Bank got wrapped up on some of that. But Credit Suisse, I think more than any other bank in the world, was caught again and again and again and again and again over those things.
Yeah, so it's no surprise when this came out this week, the market tanked on Tuesday because of the news of Credit Suisse. Really? Go look at it, I mean, come on. They've been, it's like one of the Hollywood stars. I mean, speaking of Hollywood stars, they'd make a movie about that. That is something that Hollywood could make a movie about. And it's like, one of the Hollywood stars is a disaster having another going into rehab again. I mean, like nobody knows. Come on.
Yeah, it could be the wolf of banking. I mean, it's the
Exactly. I know.
Same kind of debauchery and everything taking place at that bank.
Everything, yeah. So, that's really no surprise that happened. Will the bank fail? I don't think so. But the stock is down $2 or something.
Yeah, but the Swiss Central Bank said they'll bail it out. So,
yeah.
I mean, that's not the first time the Central Bank of Switzerland has done that either.
Yeah, but does it have a reverberating effect? Like, we're going to see a lot of what everybody's worried about is what's the contagion? Is anything at Swiss Bank contagious to all the European banks? Probably not. Is SVB contagious to all the other smaller regional bank institutions that are not one of the 30 big banks, like, maybe KeyBank, Fifth Bank Corp, or Regions Financial, so some of big regional banks? I think it's kind of an isolated incident. And if there is any, I guarantee you there's people out there that are the risk managers at those banks are looking at their balance sheet and those long-term bonds or whatever they're holding and saying, okay, what are we going to do here?
Yeah, I think it brings a heightened awareness of what's happening in the banking system and a heightened awareness of what has to happen with uninsured deposits and how do you handle that? We went through Dodd-Frank after 2008 and the regulations were loosened up in 2018. I always find it amazing that, and maybe it's more true of 2008 than SVB, but the banks don't want any regulation until they need to be bailed out.
Yeah, I know.
Then they want the government help.
Then they want help, yeah.
And as soon as they get the government help, then they don't want to be regulated anymore.
Yeah, it's like my kid when we were little.
And some of them want to do their own stress test.
Well, one of the rules that they changed in 2000 was because of he died was the Volcker rule, which basically about off the derivatives and off the balance sheet transactions, which got all the banks in trouble before 2008. And so they wanted to, change that rule so they couldn't be as creative with those.
So I would imagine coming out of this, there's going to be more bank regulation, but putting it in a larger scale, I think it is something that investors have to look at in terms of what they listen to and who they listen to, and to shift the focus away from just what a company is earning and are they beating earnings estimates. We've talked before about the analyst and their accuracy of their estimates. Mm-hmm. If somebody misses their earnings, so what?
So what? It's as like we talked about. Warren Buffett says, "Who cares about quarterly earnings? We're in for the long haul. We don't care what a stock does in 2 months. If we like the balance sheet and like the projections, okay, we're in."
And that comes into play. And even if the stock takes a drop of 20%, I mean, Peter Lynch, who did 29% per year on the average over 13 years, had times when he was down 40%. Never bothered him, simply because he said, if you can't convince yourself you're a buyer and not a seller when your stock is down 25%, you'll never have better than mediocre results. I mean, he understood the focus on earnings, and if a stock took a big hit and the balance sheet was solid,
big hit. There's nothing.
He was right there.
Yeah.
And Lynch was a balance sheet guy. Buffett is a balance sheet guy. Templeton and Price, all those people that had outstanding returns were all people that could analyze a balance sheet and looked at the balance sheet in the long term.
Yeah, I mean, it just comes down to, short term versus long term and having patience. That a company's good and just waiting for people to recognize this company's solid and the profits are going to grow.
Yep.
As opposed to worrying about, did they meet by a penny this quarter? We'll buy the stock, it's by a penny.
So anyway, Silicon Valley Bank. It's one of those chapters we'll remember, like Bear Stearns, like long-term capital. There's lessons to be learned for investors. And for me, the biggest lesson, focus on the balance sheet and not on the income statement. That makes the most sense in the world. And had people been focusing on the balance sheet and understanding where things were going, because deposits are part of the balance sheet, the number of deposits. And the rate of decrease or increase, it's all there on the balance sheet. The value of the bonds, when you're holding to maturity, you don't know what the real price is. Shows up on the balance sheet. What if you're seeing mark to market, that shows up on the balance sheet. All those assets and all those liabilities show up on the balance sheet. And what is the real cash flow coming in? That all makes sense to look. And then you can decide, is this a good buy or not? And maybe in some cases, it is a good buy. A GOODBYE. Goodbye. Anyway, have a wonderful week, wonderful weekend, and we'll be back next Saturday to talk about money.